Manish Gunwani joins us now. He's a very old channel friend, and I always look forward to our engagement. So, Manish, good to have you back. Thank you for joining us. I'm happy that you're smiling on the channel, and we're starting a interview with a smile on your face. But if you really have to look at the realistic view of the economy, I guess there is a bit of a challenge. Now, the concerns are well known, Manish. My question to you is that when do you think the revival on the consumption front and on the investment front will happen?
Well, Nikunj, to be honest, it's very difficult to model an economy saying exactly what will cause it to come back. Just the fact that 6 months back, we have seen the amount of slowdown, let's say in auto sales. I think it would have been difficult for anyone to say that auto sales will drop so much. Similarly, I guess it will be very difficult for someone to catch the bottom, but you can look at what are the drivers of the economy and what is the direction they're going. So, as I've said, basically an economy gets stimulus from three levers: fiscal, monetary, and exchange rate. And I think the heavy lifting has to be done by the monetary policy, because fiscal, obviously, we have gone in for a fairly disciplined fiscal deficit. Exchange rate, I personally think rupee is a bit expensive, but whatever that may be, I don't think the dollar is strengthening very strongly globally. So in which case you're probably looking at a stable currency right now. So you're not likely to get stimulus from there. So we've seen the 10-year bond yield come down quite significantly. Now I think we have to wait for it to percolate to the economy, where home loan, auto loan users see a drop in their interest rates. And I think the interest rate channel also works through valuation of assets, right? So there's about 40 to 50% GDP of government securities, which obviously have appreciated in value. That creates a wealth effect by itself. So there are multiple channels monetary policy works through. Now, clearly that is what will provide the stimulus for this economy to turn around. But whether it'll take 2 months, 3 months, 6 months, it's going to be very difficult. A lot of it also, I think, boils down to world growth. Now, if world growth picks up, in fact, if you see the trade data of the globe, it's probably as bad as 2016 beginning and starting to go towards 2009 kind of levels, because South Korea, Singapore are already in recession. So to that extent, you also need a bit of luck from the global side, I think. So the fact that global equities have done well because interest rates have gone down is one thing, but clearly the PMIs you see globally, the index of industrial production, the trade data, everything is quite negative at this point of time, and one is hoping that you've kind of hit the bottom in global growth. So any recovery from there, combined with monetary policy playing out in India, I think that's what's going to turn the economy around.
So, Manish, we've looked at the bullish arguments, which is monetary effects would kick in, global growth has got disrupted, and trade war issues may be behind us. Now, let's take a realistic view. And the realistic view is that India had one humming engine, which is the consumption engine. That has got stalled. And it's not going to pick up in next 6 or 8 months. Given that private sector capex is poor and it is unlikely to pick up because of XYZ reasons, we both know the reasons. Where is the economy headed? Consumption is slowing down, investment is yet to pick up. I guess we are getting crunched now.
Nikunj, the point is that what drives consumption, a lot of it is softer factors like animal spirits and sentiments, and you never know when they come back. So if you look at consumption from a very top-down macroeconomic perspective, you take the assets of the household sector versus the debt. India has a super balance sheet on the household side. In fact, our estimate is that it's a better balance sheet than even US, because if you take the assets to debt ratio, the household sector's balance sheet on an aggregate basis is quite fine. Now, clearly from an income perspective, from the P&L perspective, last 5-6 years, not too many people have seen their wages, salaries, profits go up too much. But as I said, the balance sheet is fine. So it's not that consumption is being stalled structurally by a bad balance sheet at the household level. So I'm not sure you can say that consumption will not pick up, because balance sheet is fine. Also, if you see certain segments, especially the premium segments, when you look at luxury cars, air travel, QSR, it's not that nothing is firing. There are segments, even AC sales, for example, apparently are quite strong at this point of time. So there are segments which are firing. So I don't think it's a problem of affordability or balance sheet. It's just a question of sentiments to a large extent. And that's what I said, that what drives the economy back to recovery is a mix of hard factors like interest rates and global growth and all that, but it's also a bit of sentiments which are very difficult to predict, along with the fact that also what tends to happen in many industries is when the final sales goes down, let's say 2%, the manufacturer actually see 10% because the entire inventory channel or destock. So there is a kind of escalation of that. So what I'm saying is it's not easy to predict that consumption will not come back. But I'm hoping that generally interest rates are a very powerful tool for the economy, and that along with a bit of global growth should drive sentiments back.
Right. Manish, now everyone's betting on a rate cut. What's the best case scenario here, given the expectation when we do see that cut coming in? What would you feel is the best place to be in the markets? Would you be looking at discretionaries, utilities, banks? What would you say is the best way to go?
So first of all, I don't think a single rate cut does it. I think this economy needs maybe 50 to 100 bips of easing on the 10-year yield, and probably much more on the user side, because the first 75 bips or so clearly is not really played out either at the corporate which is borrowing or at the consumer who has a home loan or auto loan. So I think that transmission is probably a matter of time, and that should happen. So effectively for the user, you're probably looking at 100 bips or 150 bips kind of reduction that needs to happen, to my mind. Now, if that happens, obviously, given the slow economy, I think the rate sensitives with a value bias is where we are positioned. So we're talking about sectors like corporate banks, utilities, real estate, hotels. Those are the spaces that we think are good risk reward at this point of time.
Okay, Manish, wanted to also get in your take in terms of individual sectors as well, and wanted to know the outlook as to how you're positioning yourself within the auto space, given the kind of slowdown as well that we've witnessed.
So auto is a bit of a tricky sector, because what has happened is that you're obviously seeing a very sharp cyclical slowdown, but also there is an overlay of a long-term disruption in terms of EV. Now, obviously, it'll take a lot of time, but what probably will get manifested in is the multiples rather than earnings at this point of time. So if you see globally, auto sector multiples are very low at this point of time, because the path to that technology in terms of whether it is hybrid, it is a full battery based EV, is not very clear at this point of time. And a lot of ancillaries obviously have exposure to different parts which may or may not be required in an EV. So in general, I'm more in favor of the CV cycle rather than the PV cycle, because the passenger vehicle tends to be a less cyclical, more compounding kind of growth versus the CV cycle. Now, PV is where the technology is probably going to be the focus. And what's going to happen is you're going to see companies divert the cash flow or do various kind of alliances to come over this technology hump in a certain sense. And it's very difficult to predict what they're going to have to sacrifice to be able to manage this wave of technology change that is coming. And obviously markets don't like uncertainty for the long term, and to a certain extent the auto sectors, especially the PV side, is facing that. The two-wheeler side again also has a disruption potential, along with the fact that it's also very penetrated. So it's not going to be a high growth sector on a 5-10 year basis. So among all the various spaces, if I look at it, at least personally, I think the more cyclical sector, which is the CV cycle, is probably worth a bigger bet than the other segments.
Manish, there are two ways to look at things. One, there is a slowdown because of interest rates, because of monetary stimulus. Those sectors will come back. Now, whether that is autos or whether they are part of discretionary. But where are you still convinced that the structural demand stroke earnings is still intact? Where right now markets are nervous because of variety of factors, but this is a trend in making. This is a trend which will be a bigger trend than what it is right now after 2 or 3 years. I mean, if I look at some of your holdings, Manish, you went against the market and you bought into Tata Group of companies. You went against the market and you bought into Inox. You went against the market and you went, into Jubilant Foodworks. These are good picks which you've done. Which are some of those ideas where you're convinced that, come rain, come sunshine, come water, come flood in Mumbai, you are a convinced buyer?
Not easy to find that kind of resilience, to be honest. But basically, I think, as you said, the economy is slow. We have to accept the fact we don't know how long it's going to be slow. So what I think is probably a good strategy is to buy into stocks where there is consolidation in the industry, buy into stocks which are getting market share at a valuation you are comfortable with. Now, obviously, a lot of these names are expensive, but I think if you look at spaces like real estate, aviation, hotels, a lot of these spaces, there is consolidation. There are some stocks or companies which are getting market share. So you want to be able to say that even in a slow economy, this company or this segment is getting market share, and there is a 10, 15, 20% growth in earnings for next 2 years at a reasonable valuation. And if the economy picks up, then you get a bigger upside. The other way to play is asset-based cyclicals like cement, mid-cap cement maybe, where you have a certain operating cash flow or free cash flow yield. And you say that if this is roughly equal to my risk-free rate, I'll just hold it as a quasi-debt stock till the cycle comes through. If the cycle comes through, it's a multi-bagger. So I think you have to match these two themes and build a portfolio. Apart from some exposure, you'll always have to the high-quality stuff like retail banks, which I think are still fine because there is obviously market share gain not only from PSU banks but also from NBFCs at this point of time. So I think you kind of mix and match the portfolio between these three buckets.
Just to touch upon real estate for a moment, given the condition the market is in and how low prices are, some of the stocks, however, are actually at all-time highs. Select names, but definitely a trend that seems to be emerging there. Why do you think that is? What explains the dichotomy that we're seeing?
See, I think you have to realize that it's a very big market. So even after the slowdown which we've seen over last 5-6 years, the Mumbai market, there's no very accurate estimate, but somewhere between 50 to 60,000 crores maybe of new home sales. The top 8 cities are probably about 2 lakh crore odd kind of market. Now, is this a small market? No, obviously it's a very, very big market. And this market today, the sales are probably the same as 2010. So it's gone through a fairly prolonged consolidation in terms of sales. Now, is there a basis to say that this industry is going to consolidate? I think the jury is quite clear that it is, because whether you take RERA, GST, demonetization, NBFC crisis, everything seems to point to the fact that your top 5 or top 7 developers in each city will get a disproportionate market share. So you're likely to see some companies become very big, which is why I think the state of the industry is diverging from the state of the stocks of the leaders. So clearly, even if the market, I think, is probably not going to grow for 2-3 years because real estate prices are going to be flattish, if I can find a company which has a good balance sheet, which is aggressive in sales, which has a good brand, then if it's available below your NAV and you can be conservative about your NAV assumptions, I think it's a good bet.
Manish, let's talk about the overall portfolio. With a thrust to some of the Tata Group companies such as Indian Hotels, there's been Trent, Tata Global Beverages. Can you just, sort of elaborate a little bit more on the rationale and, tell us what kind of companies you're picking?
So it's not, frankly, a group level call we're making. It's just company specific. So there are various segments. As I said, can't talk about individual companies, but hotels is again one of those sectors where we feel the downside is limited. There is a bit of consolidation going on, and if at all the cycle comes out strongly, you make a lot of money. So as I said, you want to be in sectors where the downside is protected either by a asset or normalized earnings, because as we discussed, it's very difficult to call when the economy is going to turn around. So part of it is that one of the companies is a consumer company where we think the portfolio is changing to a very exciting configuration, because what the premium segment, as I said, is doing well. So the premium QSR, like a coffee chain, is obviously got a lot of potential in this country, I think. And there are options of converting some unbranded categories into branded. So each company is actually very different. It's not, to be honest, a very wide group call we're making.
So Manish, I'm going to ask you a very simple question. Future return, past return is no guarantee of future returns. But if one looks at the bond yields, inflation, risk premium, and other factors which often act as an indicator of returns, in next 3 years, do you think a good, well-run equity scheme like a Reliance growth scheme can give double-digit CAGR returns for next 3 to 4 years?
I'm very confident of that, because apart from the scheme, see, my overall configuration, I think, is that from a top-down perspective, that last 30 years, the broad way India worked was having consumer inflation of 8%, nominal GDP of 14%, inflation differential with US was 4 to 5%, which was exactly the rupee depreciation if you take what happened on a 30-year basis. And that nominal GDP of 14-15% is broadly the same what Sensex returned. Now, I think that configuration is changed because both due to global factors and domestic focus of policy, you're going to see inflation remain probably at 4.5% average, in which case your nominal GDP goes down to probably 11-12%. Your rupee depreciation probably slows down to 2 to 3%. And I guess over the long term, broadly, nominal GDP will be very similar to what gets reflected in the Nifty or Sensex. And I think that there'll be opportunity to create double-digit return purely from broadly the market, and then obviously we hope that we will create substantial alpha as well. So I think medium to long-term good funds should create somewhere between 13 to 15% return.
Manish, great having you on board. Thanks so much for being as candid as you can and telling us about your market outlook as well as your position. That's the view coming in from Manish Gunwani on ET Now.